Okay, so hello. Good afternoon, everyone. I'm Victor P. Holt, President and CEO of VTech Solutions and board member of the HUBZone Contractors National Council, where I serve as treasurer. On behalf of the council, welcome, especially those of you who are new to the council. Our mission at the council is to strengthen HUBZone certified small businesses by expanding access, building capacity, and ensuring that companies rooted in historically underutilized communities can compete and grow. Today's discussion I'm really excited about, and it's on mergers and acquisitions, which is timely as rising capital costs, shifting federal priorities, and increased competition are reshaping the landscape. For small businesses, M&A is becoming a strategic tool in order to scale and make sure that we have long-term positioning. Today, we're joined by an exceptional panel. John Shiraka and Trevor Skelly of GovContractPros and Aaron Andrews of Turning Rock Partners. Their expertise in federal contracting, policy investment, and strategic growth will ground today's conversation. So thank you all for being here. Let's get started.
Trevor, you want to kick us off?
Sure. Thank you, Victor, again for having us to present to the HUBZone Council. As you said, we think that this topic is incredibly timely, and we're also really fortunate to have Erin on the call as well to walk us through some of her perspectives and what she's seeing in the federal marketplace currently. So we're at a high level, we're going to take a look at the federal marketplace landscape for mergers and acquisitions. And then we're going to talk about identifying a target. And before we close out, we want to make sure that in connection with any M&A activity that you might be contemplating, that you're aware of some of the SBA regulatory requirements, as well as the FAR regulatory requirements, as there have been some pretty significant changes in that space. And then lastly, we also wanted to consider M&A activity in the context of the SBA's mentor protege program, and joint venturing more generally, as there are some specific rules there, and recognizing that joint venturing and the mentor protege program is incredibly important to success. We wanted to make sure that we covered those topics as well. I
Trevor,
think, go ahead,
if
John.
if I can just real quick, just sort of at a high level before we jump into the current landscape, I think just sort of at a high level, and we'll talk about this in the session. And first of all, thank you for the council for having us on. Thank you, Aaron Andrew, my good friend, for being on this session and bringing your perspective. I think it's a really important perspective for the audience. At a very high level, I think we've seen a dramatic change in the federal market landscape in the last year, right? I think no one can sort of deny that. And I think that has had reverberations across the landscape, including the small business set-aside programs, as well as sort of what we're seeing in acquisition and M&A. We'll get into sort of the specifics around, what folks are looking for in acquisition, what the regs are. But overall, sort of the shift that we're seeing is a significant consolidation of contract requirements into GWACs, which creates a burden or an uphill sort of struggle for new entrants. So a solution to that oftentimes, and we've seen this, and I mean, I think everybody on this panel has seen this, a solution for entrance into the federal marketplace, even historically, has been growth through acquisition as opposed to organic growth. Given what we're seeing in today's world, I think growth through acquisition takes on even a bit more importance. But at the same time, regulations are constantly changing with respect to buying and selling set-asides and what are the challenges there. And then overall, can you operate or benefit from what you just acquired? And do you want to make sure that, the benefits actually flow to the acquirer or the buyer? But I think that's just sort of high level, laying the groundwork. Real quick before you jump into this, Trevor, Aaron, any comments like sort of high level with respect to what you're seeing before we jump into the actual slides?
Yeah, and I'm happy. I think we've got a slide kind of covering it, but great to be here. Thank you to the Hub Zone Council and to GCP. Very grateful for the opportunity, and you're with the right experts on the GovCon side. I'm happy to talk through a little bit what we're seeing in the market by way of, mergers and acquisitions and lending in general and how folks are utilizing it. I think we have seen, deal volume down a little bit over the course of 2025. That's not just specific to GovCon, but we have seen that across the board in every industry. But I think to your point earlier, John, the market has changed significantly over the last year for GovCon, just with Doge and everything else. So I think we've seen a little bit more of a hit in the small business space, but also opportunity to your point with, some of these things coming up and changes to the regs. So looking forward to kind of going through that in a little bit more detail and what we've seen in the market writ large.
And
Aaron,
Trevor, real quick, I'm sorry, I forgot to do this. I apologize. If you have questions, I think HUBZone Council put the note in there. Please just use the chat box. So it's on the bottom. Just hit chat. I will try to monitor that, and I will ask the panel questions as they come up as we're presenting. But feel free to ask questions. We love discussion and dialogue.
and I think the folks on the call are pretty well acquainted, obviously, with the HUBZone Council and with us at GCP. But Aaron, would you mind just talking a little bit about what Turning Rock Partners is and your
Yes.
role there, so folks have a better idea of your perspective and where you're able to come in the marketplace?
Absolutely. Thank you. So Turning Rock Partners, we're a private credit structured equity shop. So we're not private equity, we're not investing, we're not buying businesses, but we're providing credit oftentimes with banks to help with leverage if bank leverage is a little bit down, which we have seen, you know, especially post Silicon Valley Bank and a couple of other things, leverage with banks has gone down, especially in the small business space. We're able to provide additional capital. So it is non-dilutive capital. So if you want to maintain, and I think it's very important if you have set asides, you want to maintain those set asides, you need to maintain those set asides. Bringing equity in can be challenging. So you want to be able to grow. We can provide that capital and we can write checks anywhere. And we're above kind of where that SBA 7A loan limit is. We're kind of the 5 million to 60 million, so much larger businesses, but also small businesses. We have an SBIC. And we focus a lot on owner operators, non-sponsored deals. So folks looking to continue to grow their business, but don't want to necessarily sell a lot of equity to do so. So that's what we do. We are not GovCon specific, but just giving kind of backgrounds. We know GovCon well. We like GovCon, but we do every industry essentially.
Thanks, Aaron. And so to that, I mean, we wanted to, and I think we've covered, generally this slide on some of the previous iterations of this presentation. But I think here the highlights again were that, contract dollars, to John's earlier point on the GWACs, we are seeing a significant concentration in the awardees. So year over year, contract awards, the number of contractors receiving those awards is declining pretty precipitously. And given the executive orders, particularly around utilization of government-wide acquisition contracts, best-in-class management, OFPP will be publishing here, probably in connection with the Revolutionary FAR overhaul, a list of must-use contracts. So really the government's intent here is to reduce the number of local contracting options and really try to get contracting offices to utilize these government-wide acquisition contracts. So the trade-off there can be pretty high in terms of barriers to entry. I mean, if you're iced out of one of these government-wide acquisition contracts, while there is talk about having on-ramps, many of them do not. So I think the most infamous at this point example is STARS 3. So STARS 3 being an 8A contract, the first option period is coming up for exercise here this summer. That's a 5-year ordering period. So unless you're, sort of on that contract or, one of the ways that you can get on that contract, theoretically is through this type of merger and acquisition space. But here, again, the purpose of the slide just being to make sure everyone's aware that, the quantity of recipients receiving federal contracts is declining, but nevertheless, the average award for those contract values, the average award value of those contracts is increasing also pretty precipitously. John or Aaron, do you have any, sort of comments on the contracts, the marketplace structure that we're presenting here?
My only comment is it is sort of what we've seen with respect to centralization, and you mentioned that at the GSA. Similarly, we've seen sort of the pilot program across smaller agencies where they've farmed out their acquisition process to the GSA, and to a significant degree, if not entirely, have closed down their acquisition shop within the agency. So those networks, those relationships, those can become stale, right? Because your acquisition points of contacts, maybe not your program office, but at least your acquisition point of contact changes. And so one of the things you do when you look at M&A is you're buying those networks and contacts. And so if that's a shifting environment, you really want to, and that's why we're seeing a lot of these acquisitions sort of discounted at this point, right? Not only are you seeing the consolidation, but what you're getting is in a shifting sort of landscape. So people are uncertain about what they're acquiring, and those relationships are part of the acquisition process. That sort of jumpstarts your entry without having to build those relationships, but you want to be very cognizant of changes in the acquisition process at the agencies you're buying into.
I think, Aaron, I think you had some thoughts on this slide in particular. Can you walk us through what you mean by saying the market is active but selective?
Yeah, great. Let's start with that headline. And I mentioned this a little bit. Yes, deals are down, but I don't think that's the whole story. So overall, small business M&A volume dropped 15 to roughly 23% last year. And that's, like I mentioned, writ large. We use a lot of GF data reports. That's writ large, not just within GovCon. So fewer deals are closing, but pricing for quality deals has held steady. So we haven't seen a shift in the pricing of those deals, but there are fewer deals getting done. So people are just being more selective. So if your business is clean, profitable, you've got good financials to back it up, contract diversified, buyers are still there. They're just much more disciplined. And that could be in part due to the fact that it's harder to get debt. They're less likely, there's a lot of uncertainty. There was last year, and I'm talking specifically about 2025. So they're just being much more disciplined about what they are investing in and what they are buying. And I think a question I get a lot, and just on the second point, and I'm sure everyone on this call thinks about this with their own business, is, what businesses are actually worth. And I mean, that is somewhat of a subjective thing, right? Everyone thinks, businesses are worth a lot. Sometimes they are, sometimes they're not. And I think it's important to be realistic. So what does, the multiple actually look like for this small GovCon business? And I think I will say this, if you go in talking to a neighbor and understanding that your neighbor got a certain multiple and you want the same thing, don't necessarily set your sights on that. It's just like a house. If you overprice a house, it stays on the market too long and someone thinks that there might be something wrong with it. So getting a deal done, you want to enter with realistic expectations. So what are those realistic expectations? I think a lot of it depends on the number of buyers, who's buying, what it looks like. And the small GovCon business side, like maybe, anywhere from revenue ranges of 2 to 25 million. We've seen everything from 2 to 7 times. That depends on set asides, full and open, agency mix. So it really depends. And the more buyers you have, obviously, the higher multiple too. Businesses with cleared workforces, prime contract positions, defensible, recompete pipelines, commodity IT or heavy subcontract is sometimes a little harder sometimes. So I think you really need to understand, what you have and then what would that multiple be. And part of it is just, asking, potential buyers. I think the other thing to think through is a lot of folks are depending on debt to buy these businesses now. And if you don't have a backlog, not pipeline, but backlog that can pay back that debt, it's going to be challenging for them to get that debt. So that could also lower the valuation and the overall multiple. So it's a little bit, and I'm happy to kind of talk through, answer any questions, but also talk through how we're seeing these deals get financed. I talked a little bit about it, but happy to kind of walk through that as well.
So I think real quick on the first two bullet points, Aaron, I think you make a really good point with respect to backlog, and what buyers are looking at least from our perspective. In a lot of instances, we support tribal organizations looking to do acquisition and to finance that acquisition either through organizations like yourselves or banks. And backlog is critical. So a lot of times, small businesses, and I used to own and operate a small business that my dad started back in the 80s. And small businesses have an incredible knack that they've accomplished with respect to the success they've seen, but you can't make it sort of a operation around one woman or one man, because what the buyer will look at is there infrastructure, right? Because post-acquisition, how long are you going to stick around? What am I actually acquiring? Am I acquiring an individual? I could hire an individual. I want to buy an organization. So it has to have the infrastructure. The backlog is incredibly important and it's significantly analyzed. And the other thing about backlog, it has to be profitable backlog, right? You can't go
Yes.
out and underbid a $51 million contract and lose $30,000 a month and be like, I got, a $51 million contract. That's not going to help me if it's losing money every month. So I think when you look at the marketplace, it's what's your backlog really? What's the profits flowing off of that backlog? And then do you have the institutional infrastructure? So when you take that individual out of the picture, and hopefully that person doesn't disappear. And I guess, Aaron, I'm curious, like your thought around the owner
Mhm.
operator staying on, because from my perspective, a lot of times when it's a nascent tribe or even a nascent buyer, hopefully that owner operator doesn't disappear. They continue on. And then now apparently there's restrictions, and I know I'm going off track, but I know you know this. There's restrictions at the SBA and the 7A loan where that person can't stay longer than 12 months,
Yes.
apparently. So what are your thoughts around that? And does that create an issue with respect to acquisition and transition plans?
Great points. I'll address first kind of the person staying on and then why the backlog matters so much from someone who's buying in the debt perspective. But you're exactly right, John, and I was going to mention that. It really depends on how someone is financing the purchase, right? You're correct. If someone buys your business with a 7A loan, the previous owner, can no longer stay on. There's like a 6 month transition period where they can be paid a little bit, but that owner needs to be out at a certain point. So, regardless of who's buying, that is required. If it is a tribe or a strategic and the owner can stay on, that is great. I think folks would like to see that because it is continuity. However, if you're looking to sell your business, you should be putting things in place years before to ensure that you do not have to stay. That will only increase the value of your business if the business is not entirely dependent on you. Have a good management team, have folks that are, building the relationships with the customer, because that is a risk for any acquisition. If it is a one person show and things will leave, relationships will leave post transaction. I think to your point on the backlog, so think of it this way, and banks are going to be this way, private credit. You want to know for every dollar that's being loaned on a deal, you're going to be paid back that dollar in addition to more. And that is what the backlog ensures. It is ensurety that there will be cash coming out of the business to pay a loan back. So if anyone is borrowing money to buy a business, they need to know that that backlog is there. It is not pipeline. It is not, a a larger contract that then would require task orders. You need to see backlog with those task orders laid out to ensure there is money coming in from a cash flow perspective to pay off whatever the buyer is going to borrow.
Awesome.
John, could I ask a question? I'm sorry, because I'm sitting here and I'm listening. I'm getting a little excited. Something I'd like to hear you talk about because of the uneasiness with small business right now, not knowing where we're going any given day just because of what we're seeing coming out through SBA and through the administration. And when we're talking that if an acquisition occurs with the new laws, then that owner becomes a ghost. Is this an opportunity to start thinking about how you can create a platform where two small businesses may merge to get to a certain point, establish a new normal and critical mass, and then start going after M&A? Because what happens is that you get rid of a lot of duplicity along the way, and you help to strengthen your own base. But then you have the owners that are still there that can nurture and can continue to grow not only what's in the pipeline, but organically what's in their backlog. Any thoughts around that?
And John, I'll let you jump in because I know there are a lot of rules and regulations about affiliation size and other things. I'll just
Yeah.
say basically, when you're looking at any acquisition, any merger, there's just going to be a lot of, there's a lot of risk with consolidation that's important. But I think you just have to really understand what the regs are. And I think operationally, be very much in line. It has to be someone you know well. It's someone you know well, because I think there's a lot of risk with people not agreeing on certain things. But John,
Yeah,
I
I
defer to
mean,
you and Trevor.
yeah, so I'll jump in real quick, and I'm sure Trevor has some thoughts on this around sort of the challenges with respect to the set-aside contracts. But what I would say is that I think what you're describing, Victor, is a merger of sort of equals to build capacity to then maybe look to do an acquisition post that. But that merger almost to a large degree looks and smells like an acquisition, right? Because if you don't structure it in a way where someone ends up controlling the organization that's merged, I think just as a business sort of function, you will have sort of a little bit of chaos, right? So even though you're quote unquote merging two equals, ultimately you're going to consolidate operations. Ultimately, you're going to consolidate management. So you'll have sort of someone that exists posts versus two that existed previous. So in a lot of senses, you run into the same type of questions around acquisition. And then obviously, I think maybe Trevor, you can speak to this is depending on who's merging,
Mhm.
right? Who prevails? So if they're set aside, do you still prevail as an 8A or a woman owned or a service disabled? Do you prevail with respect to size? And what happens to existing contracts? But I think those all become questions or issues to address.
Yeah, I think Victor, I mean, and also thank you for exercising, I guess, host prerogative and asking a question to the earlier point. We do love questions. So as folks are, listening to this, please feel free to either chime in or drop something in the chat. But, there's also, I think, with regard to HUBZone, there is unique provisions there for management for mergers and acquisitions, particularly for affiliates and establishing because there is a way to merge, but effectively keep two separate companies in order to continue to qualify for HUBZone purposes, such that, the two companies are, to your point, affiliated for size purposes. But, if you happen to be in a manufacturing NAICS that has an employee size standard, you're still considered small because you might only have between the two companies 100 or 200 employees, and that size standard is 500 employees or 750. So you're small, even though you've merged, you're small for those purposes. But then you have to take a look at to John's point, what sort of socioeconomic program do you want to prevail? Because with the hub zone rules, as long as there is a clear line of fracture between the two companies, such that there isn't a significant amount of business activity between the two, you're supposed to have different lines of customers, but ultimately you can have some third some back office services that are provided by one company to the other, and there are restrictions there, but that does make you a little bit leaner and a little bit meaner because you can consolidate those services into one entity and service both. So just looking at again where your contracts are coming, where your contracts are coming from, how they're coming in, are the socioeconomic certifications, are you relying on those? Are those a critical thing that you have to maintain to go forward? On Aaron's point, for example, on the pipeline versus backlog, HUBZone is particularly unique in that regard.
And I think someone just asked in the chat, how do you merge and maintain two entities? Disclaimer, we are not attorneys, John and Trevor, I'm sure you have thoughts on this,
Yeah.
just speaking to a lot of attorneys.
Trevor actually did a session on this, and because we've worked with a few clients around this, because you can potentially be found affiliated for size purposes, but unaffiliated for HUBZone purposes. In other words, they won't include all the employees because let's say you make an acquisition and that other acquirer doesn't qualify or the acquired firm doesn't qualify for the HUBZone program because they don't have any HUBZone employees. So you don't want to combine your number of employees for determining HUBZone status. There is a structure, and I don't know if you're doing this session this year, Trevor, but maybe we can do this session for the HUBZone Council on a webinar at some point. To Trevor's point, if there's a holding company structure and there are two entities that are clearly fractured, where they are potentially in different industries, right? That you can claim that, and I'll give you the background for this, and I know the HubZone Council knows this, and I know Michelle knows this. What happened is years and years and years ago, HubZone companies would go out and buy a McDonald's, like in Southeast DC. And they would say, well, okay, I now have, 35 HubZone employees. And the SBA was like, yeah, but they don't do what you do, like you do architectural engineering. And so they said, you can't count those employees for the purposes of the HubZone program. They are fractured. And so if it works one way, then it can work the other way. So if you can claim that what you just acquired is held through a holding company and it's not in your line of business, then you cannot count those employees for HubZone purposes. But you have to structure it appropriately. You would have to Aaron's point, have an attorney sort of guide you along this path as well. We work alongside that attorney, but we have worked on deals with respect to that structure. I don't know, Trevor, if I mangled that totally, but
No, no.
I'm sure you can clean it up.
No, I think that is exactly it. Like we said, HubZone, the HubZone program is unique in this regard, recognizing that there is an opportunity to preserve HubZone status, provided certain controls are put in place, certain limitations are put in place. And we have seen a number of clients successful in this merger and acquisition strategy that is unique, but it does require a lot of planning in terms of not only leading up to the acquisition, but certainly post-close and ongoing maintenance and compliance with these regulations it can be a challenge. But again, the opportunity for significant cost savings, Victor, to your point, if you can consolidate sort of back office functions and offer better pricing to the government because HubZone requirements are they are competed and price is a critical factor there. So to the extent that you can reduce that overhead cost and that overhead burden, that is something that makes you particularly attractive for award purposes.
So real quick, Aaron, I know you sort of talked about how deals get financed, and we've talked about who's buying, but do you have any comments on sort of the last three bullets on this page before we move on?
Yeah, I mean, I think really quickly on how they get financed, we talked a lot about the debt and the equity, and I just to what we've seen in the market more recently, you know, add-on acquisitions. So if you do have private equity or someone coming in and they're adding on deals to an existing platform deals, that's usually when an established buyer folds your company into that existing platform. Those carry significantly more debt than standalone kind of platform deals. And we've seen a shift in that more recently in the small business market, especially in the past year in 2025. So these buyers, I would say, are putting, the buyers of these add-ons are putting less equity at play, and using more debt than they have previously to do these deals. And it matters because, understanding deal structure and where that comes into play and understanding, like I mentioned, the leverage earlier is really important. And I think financing conditions improved modestly in 2025 with average senior debt pricing for these platform deals declining, to its lowest since 2022. And I think it's making it more of an accessible environment for, credit-worthy buyers. I think, like we mentioned earlier, fewer deals are getting done, but people are pickier. And so very credit-worthy, buyers are able to do these deals. And then in terms of who's buying, PE activity has meaningfully slowed. I know and we've talked a little bit about this with the new rules too. There are obvious challenges with affiliation and other things, but at this level of the market, we saw a bit of a slowdown in 2025. So so who are those active buyers? I think large primes are acquiring, sometimes for vehicle access, NAICS codes, cleared personnel, not just revenue. You see that especially, as they're looking at the small business space. I think PE activity did decline sharply last year just because there was a lot of unknown, right, in the GovCon space. There was a lot of unknown, and you heard from a lot of PE folks that they're kind of just waiting to see what happens. We'll see in 2026 if that continues, if that picks up. I think you kind of can see where, positions that people were in the GovCon space, those that did well, those that did not do well in 2025. So some of these funds might have a bit more of an idea of where they want to put that equity. The buyers right now, quite frankly, that are the most active are other small businesses. And I think you see that in the set aside. I mean, you have to buy, similarly situated in the sense that if you are an SDVOSB, you need to buy, to sell to another SDVOSB. So you do see more small business transactions and then independent sponsors. So folks that are not, PE and have a committed fund, but independent sponsors who are getting in, who raise the money to then purchase. And you see those independent sponsors leveraging debt more, I would say too. And then I would say small to small deals are increasingly favored as you're going to hear, and we've talked about just with some of the shifts in the regs, just to preserve, the set aside contract eligibility under, the SBA final rules. So those are some things. And I think, the Doge effect on valuation, we will I think we're starting to see where that panned out last year. We're seeing it in the data, but I think we'll have a better idea as we see more transactions in 2026. So I think finally, how do you make your business more valuable today? In April of 2026, I think the four things to really think about, and I think they're the same things that you would always use when you think about making your business, more valuable. Diversified agency base, anyone who's buying is gonna look at risk from a particular customer or contract. That's true in in the private sector. That's true in the GovCon sector. In the public sector, you really want to ensure if one contract goes, the whole thing doesn't come falling down. So ensure that you have diversified agency. Obviously, DOW is a huge agency, so you don't want one program at DOW. You might have only a DOW, but you might have so many, a couple of different or 5 to 10 different ones. That's important. Prime contracts are good because there is, that commitment from the federal government. So I think, you want kind of a balance of if you have sub work to potentially move to more prime work if you can. I think that does help with valuation. Certifications, that are actively maintained, things that are transferable and important, and revenue that survives, a buyer's recertification. So really knowing the rules and the regs. And like I mentioned before, the more backlog, the higher the value. That is incredibly important, go forward. So that's just some additional things to think about. But I know John and Trevor, you see so many of these transactions, so I'm sure you have other thoughts as well.
The one thing that I would add, because I know we have a bunch of stuff that we want to get to as well with respect to sort of the rule changes, et cetera. But the one thing that I'd add here is, and you mentioned this, Aaron, is your company being quote unquote clean, right? So there's a lot of smaller businesses, even in the 5 to 10 to $15 million range, where their infrastructure can't around accounting, finance, CFO functions. If you go into an acquisition and you're working on, a spreadsheet and something out of QuickBooks that doesn't really present your company well as far as an operational financial system, that raises a lot of red flags because that can't be audited. The due diligence becomes a disaster. So even for smaller businesses, sort of outsourcing, and building it is difficult, right? So even outsourcing that function effectively to a qualified organization becomes really important because the buyer needs to see the professionalization of the organization, and finances is one of the most important things that they're going to look at with respect to being able to trust what you're presenting to them as far as revenues, gross profits, and net profits. If it's not organized properly and the infrastructure doesn't exist, it becomes a challenge.
That's music to my ears, John. You are 100% right. And you don't, having a CFO is great, but so many small businesses, they're just not big enough to have a CFO. So to John's point, if the CEO is doing all of that and you're trying to sell, there is generally going to be, a challenge. You want to outsource where you can or have someone internally that has a good view with a financial background, a CPA potentially, who really is able to organize that well. That will go so like very far because you see too many small businesses who have not really put time into that, and it makes a difference when you go to sell.
Awesome. Awesome. I think with that, I think we can, move on to, some of the regulatory changes that I think Aaron, you alluded to this earlier, and we've discussed this slide, but the required use contracts and the GWACs with on-ramps. But I think this slide was critical because you had mentioned, last year that that M&A activity definitely declined, in 2025 despite the fact that these recertification rules that the SBA promulgated, there was a delay of a year so that so that small businesses could line up or figure out what they wanted to do or decide whether or not to keep plugging along or to sell. But that January 2026 date came and went. And we didn't see the, quantity of transactions that we were expecting, given the delayed imposition or delayed effective date of these regulations. And I guess, looking back, I guess we can say that that is due to, sort of the uncertainty in the federal marketplace, starting right off the bat with Doge and then, significant consolidation. But we didn't see the increase in M&A activity that we were expecting last year.
Yeah, and just real quick on this, I think because it becomes, at least from my perspective, even having run these programs at the SBA, becomes these rules sometimes become so confusing and convoluted. And Trevor, you can again clean up what I might mess up here. But I think basically, and Aaron pointed to a really interesting exception to the rule, is that if there are two small businesses that merge or one small business acquires another, and then you are other than small post acquisition, you can still qualify as small until the option period, where that's an exception from this rule. So that's an interesting exception. A lot of folks don't realize that. But I think in general, just sort of at a high level, what the rules would have allowed in the past is that if you go ahead and do an acquisition and you're no longer small, the agency wouldn't be able to get credit, but if unless the agency decided on their own that they wanted you to recertify at the task order level, they would be able to award you orders as a small business until the option period. Or if you were no longer an SDVO, you could qualify, you could still get a task order until the option period where you'd have to recertify. What's changed is that post-acquisition on these GWACs, if you can't recertify either as the status or the size, not only, and in the previous iteration before this rule change, the agency could give you the task order, but they couldn't take credit. So they couldn't take small business credit. They couldn't take STVO credit. In an SBA's mind, that was fine because at least the agency wasn't getting credit. They would have to go elsewhere to get that credit. What the rules change is that no, not only do you not get credit, you can't issue those task orders to the small businesses that are no longer qualified either as size or status. Again, with the exception of small to small acquisitions. And the last thing that I'd say is, look, if you qualified at the order level as a small business or as a SDVO, and post acquisition, you're no longer SDVO, then you cannot qualify at the task order level as an SDVO any longer. Is that a fair assessment or overview of that, Trevor? Did I miss anything?
No, you hit the nail right on the head. The crucial difference here, I think, and it's a theme that we've been hitting on throughout the presentation, is that sort of backlog versus pipeline. So here, to your point, John, if you do recertify as other than small, then you really have to be looking at the effect of what that looks like on, the pipeline piece of it, because if you're on one of these GWACs and you're expecting a significant amount of activity to come off of that GWAC, now moving forward, that those orders are foreclosed. You're not going to be eligible for those awards. So really what you're looking at potentially buying or potentially selling in the event of a size out is exclusively the backlog that you currently have. And maybe that's a significant backlog, maybe it's a highly profitable backlog, but here the critical takeaway is that, that future pipeline is effectively gone with these mergers and acquisitions, assuming
Yeah.
sales out.
And in this context, if you're a HUBZone company and someone is acquiring you that's not going to be able to maintain that status, HUBZone status, and
Mhm.
you're on the GWAC as a HUBZone organization or firm, then what happens to the potential pipeline of task orders under that GWAC? That is,
Tho-
could be significantly impacted, if not disappear.
those likely disappear, and then you're performing the contracts or the orders that are currently awarded. After that, there's not going to be additional awards coming off of that individual GWAC. So we wanted to make sure that people were aware of this, especially as they're looking at other businesses in the space, or potentially looking at what it looks like to sell their own, because to John's earlier point on the goaling versus eligibility issue, this is a huge change, a really big change that what in the past, would have been much more manageable, but SBA has decided to take these changes and make them effective as of January. So just something to be considering as you're looking in the space.
Here, I guess, from my perspective, Trevor, um, one of the things that I think is sort of important, and I know we're talking to the HubZone Council, but I also know that a lot of folks are HubZone and 8A certified. And so in the 8A context, I guess there's two things that I would point to. One is obviously the default on number one, selling of contracts is, and I know you have this somewhere, is prohibited, right? But there are instances where you can sell assets or do a stock purchase agreement, but the transfer of a contract, of an 8A contract, to a non-disadvantaged individual or non-qualifying individual or entity or organization creates the termination for convenience clause of the 8A program. And what we've seen, especially sort of maybe more currently, is maybe looking at that more closely and enforcing that more closely. And so what is the impact of that? And then there is one other path with respect to 8As. You could do a change of ownership where you basically replace, and we see a lot of tribes doing this, right? Where you basically replace a disadvantaged individual in the 8A with another disadvantaged individual, right? So you're basically replacing a qualified individual for the 8A program with another qualified individual or a tribe who's qualified for the 8A program. What happens there, and it's an easier process, easier in the context of a waiver, which has to be signed by the administrator. So take that with a grain of salt. Easier is subjective. Um, but there's an easier process, but you don't get another 9-year bite at the apple, right? When the tribe steps in, you have 2 years left, you get those 2 years. But in a lot of instances, the tribe is interested in that because they get the past performance, they get the vehicles, all the things that Aaron mentioned, right? They get the experience, personnel, clearances, all those things. So there is an interest. And I would say even in the current environment where 8As are incredibly difficult to get approved, or we haven't seen an approval since August of last year. Tribes are in the marketplace because they're looking at their 8As and their 8A runway. And as you guys know, they can have multiple 8As or indefinite number of 8As. Tribes are in an environment where their 8As are graduating and their pipeline isn't coming on stream because 8As aren't getting approved. So there are interests, and that we've seen interest in acquiring HUBZone companies, other types of set-asides. Again, taking into considerations the rules that Trevor just presented, but we've seen acquisition activity around those. And obviously, I don't know if you want to talk real quick about the HUBZone requirements. We sort of touched on that before, but obviously you need to be able to requalify as a HUBZone if you have GWACs and want to perform on this.
Absolutely, John. And I think, taking a really high level, the purpose of this slide is just to recognize that there are these notice requirements that have to go to the SBA, whether you're in the 8A program, whether you're in the Hub Zone program, whether you're in the WASB program, or and any of the programs really. And it's that 30-day notification. And this is just something that I would be considering, especially if you're thinking about buying and selling. And we do see savvy buyers and savvy sellers, include these requirements in the purchase and sale agreement because let's say, for example, that you're a hub zone and you're going to purchase another hub zone company or you're going to purchase a WASB company and the notice goes into the SBA and SBA comes back and says, well, actually you're no longer qualified. Well, what does that look like? You want to have some sort of protection or some sort of clawback, especially if you're the buyer, in the event that these notices that are going to the SBA are returned with adverse results. Having that clawback is going to be super critical. And as John said, the Anti-Deficiency Act is clear. You can't buy and sell contracts, but recognizing that if you were acquiring an entity in many instances for purposes of having access to those contracts, and the SBA has determined that you're not eligible for continued performance of that set aside, you lose that contract, you lose that pipeline. So just something here to consider, as you're, thinking about the closing conditions, you want to make sure that you're aware of the SBA regulatory requirements for notice. The FAR is somewhat similar, and as John said, we wanted to talk briefly through because in some instances clients will go with a stock purchase or an asset purchase, and both have advantages and disadvantages. And you can certainly speak with your counsel when you're considering what these look like. I mean, I will say from the contracting officer's perspective, the stock purchase tends to be the easiest because it doesn't require a full novation agreement that's required with an asset purchase. But I mean, you might also say, listen, we've done our due diligence. There's some liabilities here that we're uncomfortable with. So we really just want to do the asset purchase. And we recognize that going through the novation process with the government is going to take, 6 to 8 months because you have to get an opinion from counsel. You have to complete the novation agreement. You have to identify all of the contracts. It's a fairly onerous process, but there might be advantages to that. And we've seen this particularly when, either small businesses or larger businesses will spin off one of its operating units or one of its entities so that there's an actual contractor division that's performing certain contracts that could be acquired via an asset purchase as opposed to a stock purchase. But here again, like with the SBA rules, we want to make sure that the contracting officer, per the contracts that you have signed, you are providing that notification of ownership change, whether it be the 215-19 clause or what's going to be in all of your small business prime contracts, that 219-28 clause. John, did you have any other comments on sort of stock or asset purchases? And
No, no, I think the one thing that I'd just point to is that especially given the current environment where contracting officers who are traditionally risk averse, but more so now, what we've seen is that the novation process is even slower or and more they do a lot more due diligence, if you will, from previous times. And with your point with respect to reaching out and getting an opinion from legal counsel. And then lastly, your point with respect to clawback, if there's any issues around novation, things that you had anticipated might get novated, didn't get novated. Because they don't have to, it's the discretionary, right? They don't have to approve of the novation. And we've seen this around, for example, vehicles where there's a lot of contractors on the vehicle. They're like, well, why do we need to have this particular Stars 3 or let's say Oasis novated? Because if we lose this contractor on this vehicle, it's not going to hurt us much because we already have, I don't know, 500 or 200 or whatever other vendors on this contract. So we're not going to approve this novation. So it's discretionary. There's no guarantee that the novation will be approved. And then lastly, there should be some sort of clawback in for those instances. So,
I would just offer one last piece that we're seeing a lot here. There is a significant, contract awards are getting delayed, and I can count over the past 2 weeks, we've had numerous folks come to us just for SAM assistance. So as make sure you know when your SAM is expiring. You're going to get notifications from GSA saying go in and update your SAM. Also, in connection with option exercise on GWAX, you need to recertify your size and status 120 days prior or within 120 days of that option exercise. So I'm thinking particularly of Stars 3. Contractors got notice to, recertify size and status. So that means going to SAM, but you want to make sure that your, SAM update is always is always active because contracting officers, and we have seen this, contracting officers will not make award until the SAM is reactivated. And based on recent experience with the Federal Service Desk, the FSD, getting that SAM turned back on is taking a couple of days. Now, if that happens and you're in a position where your contracting officer is telling you, listen, we cannot make award until your SAM profile is active, just remain calm. Whether it's a sole source or whether it's a competed acquisition, the government has already drafted its business clearance memorandum, and it's certainly going to be willing to wait for another 3 to 4 days while you sort this out. But just be proactive in your communication with the contracting officers that you are indeed working on it, that you anticipate a resolution in 3 to 4 days, and you will let them know as soon as you have that profile updated. But don't panic too much if your SAM does expire. Be proactive, but ideally try to avoid that by recertifying annually and knowing when your annual recertification is coming up, and of course in connection with any option exercises on any GWAX. Um, Lastly, before we close out the presentation, we wanted to talk briefly about the mentor protege program. I mean, for small businesses, I will say that I would argue that the mentor protege program and joint venturing more generally is a indispensable strategy in the current marketplace. And we see that because, like we said, the increase in complexity of awards, the increase of size of awards. So oftentimes, a single small business is not able to compete effectively for the government's requirements. And so mentor proteges and joint ventures are super, super critical. And we've talked a lot about, acquisition on sort of the small business side. So, hey, you're a small business and you want to sell your company, or perhaps you're interested in buying other small businesses, but there's some critical rules that's worth taking a look at. If you are in a mentor protege program, if you're in the mentor protege program and your mentor is purchased, the mentor is required to reaffirm that they are committed to the mentor protege agreement that was signed, but also because mentors are prohibited from competing proteges on government-wide acquisition contracts, you do have options to continue to perform that contract without the mentor. But just something to be aware of here is if your mentor specifically is acquired by another firm, you have some rights under the SBA's program that it's important that you be aware of and you exercise those. John,
Yeah,
any?
just real quick, and if you have any questions, please do feel free to drop them in the chat or just raise your hand and speak up. The one thing that I'd say is that you guys know, I know I'm preaching to the choir, but you know the rules around, a mentor can have one but up to three proteges at any given point. A protege can only have two mentors in their entire lifetime. But to Trevor's point, if your mentor is acquired, let's say, acquired by SAIC. SAIC can potentially go above and beyond the three mentor-protege relationships that they can have by regulation, as long as generally two things happen. One is that, to Trevor's point, they confirm with the SBA that they will continue to honor the terms of the mentor-protege agreement and provide assistance to the protege. And then two, that they don't have another protege that's competing with the one that they just acquired. And by that, meaning they're not, to Trevor's point, they're not on the same GWAC and the same pool in the same GWAC. And not to get into the weeds, I know we have only 2 minutes, but Oasis is a special child because not only does it have tracks, which is the HUBZone track, but then it has, and I'm drawing a blank now, Trevor, it's the specialty areas. What do they call them under?
Domains.
Domains. So
Domains.
so you could potentially be two hub zones on the Oasis track and never compete because you're in different domains, but the regs don't anticipate that, and we're not sure if the GSA is understanding that correctly. So if you're in that boat, you're not the only ones. GSA is probably misinterpreting this, and we have sort of engaged with the SBA to make them aware of the special situation. Any questions from anybody? Comments? No?
I think they're overwhelmed, John, with the information that was given to them.
Well, always happy to follow up, Victor. You guys know this and the
Mhm.
council knows this. If there's any questions that come up afterwards and you want to email us with questions, feel free to do that. We're happy to
Right.
provide clarity and answer questions.
So, John, Trevor, Aaron, thanks for everything today and joining us. Your insights and candor, invaluable. To everyone who participated, I think we all understand this conversation matters. We see that the market is shifting, competition is rising, and businesses that will win will be the ones that move with intention, strategy, and confidence. So I hope today sparked ideas, challenged your thinking, and gave you momentum as you shape your own growth path. Now, before we close, do not miss the 2026 National HUBZone Conference at Westfield's Marriott in Chantilly, Virginia. The golf outing is July 20th. The conference is July 21st through 22nd. Early bird registration is still open, but just for a few more days. And once it's closed, it's gone. And this year's conference will be built to deliver impact. So we're looking forward to seeing everyone there. Bring a friend. And if you're serious about growth, you will want to be at this conference. So if you haven't locked in your spot, now's the time to do it. Thanks again, everyone, for your participation, and let's keep building, scaling, and keep showing the country what the HUBZone businesses are capable of.
Thank you, Victor. Thank you.
Thanks, everyone.
Everybody.
All right.
Appreciate it.